Let's talk about the 10-year Treasury. For most people, it's just a number on a screen. For the media, it's treated as the bedrock of the global economy. But if you look at how this market actually functions, a very different picture emerges. It isn't a free market discovering a price through buyers and sellers. It is a managed system where the state sets the boundaries and enforces them. The textbook tells you that bond yields reflect inflation and growth. If inflation goes ed, investors demand higher yields. It's an elegant theory, but it hasn't matched reality for 15 years. Since 2008, the most important buyer of U.S. debt hasn't been a pension fund or a foreign government. It has been the Federal Reserve itself. This is a state of vertical integration. The institution that sets the price of money has become the dominant buyer of the instruments that define that price. This happens through a specific mechanical loop. The Fed doesn't buy directly from the government. It works through primary dealers, the world's largest banks. The Fed creates digital reserves and swaps them for treasury bonds held by these banks. By removing trillions in safe assets from the private market, they force investors to move into riskier assets like stocks or corporate debt, just to find a return. This isn't just buying bonds. It is a deliberate tilting of the entire global risk scale. To understand the scale of this integration, you have to look at the plumbing of the reverse repo facility and bank reserves. When the Fed performs these swaps, it isn't just printing money, it is managing the collateral scarcity in the system. By controlling the supply of treasuries available to be used as collateral in the overnight lending markets, the Fed effectively dictates the plumbing of global leverage. If the private market needs more collateral to keep the gears of the shadow banking system turning, the Fed can adjust its balance sheet to provide it. This means the Fed isn't just a buyer of last resort, it is the central clearinghouse for the very collateral that allows the modern financial world to function. To understand why this management is mandatory, you have to look at the structure of the debt itself. We live in a credit-based economy where nothing is ever truly paid off. Obligations are simply rolled forward. The danger isn't the total size of the debt, it's the velocity of the refinance. The United States is currently facing a massive maturity wall. A significant portion of the national debt matures in the next few years. When that debt expires, the government has to issue new debt to pay back the old holders. This is the refinance shock. If a bond was issued at 1% 3 years ago and has to be reissued at nearly 5% today, the interest expense explodes. This isn't a cost the government can cut, it's a mandatory payment. We are entering a debt spiral where higher rates lead to higher deficits, which requires more borrowing, which puts even more upward pressure on rates. The math eventually stops working. This refinance pressure is amplified by the disappearance of the term premium, the extra yield investors usually demand for the risk of holding long-term debt. In a normal market, the longer the duration, the higher the risk, and the higher the pay. But because the government's borrowing needs are so massive, they are forced to flood the market with short-term bills to avoid locking in high interest rates on long-term bonds. This creates a dangerous imbalance. The government is effectively financing a 30-year house with a credit card that adjusts its rate every few months. They are trading long-term stability for short-term survival, betting that they can lower rates before the interest bill consumes the entire federal budget. This leads to a state called fiscal dominance. This is the point where a central bank loses its ability to fight inflation because doing so would bankrupt the government. Normally, if inflation stays high, you raise rates to cool things down. But under fiscal dominance, raising rates makes the government's interest bill so high that they have to print more money just to stay solvent. The cure for inflation actually becomes a driver of more inflation. We can see the endgame of this process in Japan. After decades of yield control, their bond market has become a ghost town. On some days, zero trades occur in the benchmark 10-year bond because the central bank owns almost everything. The market has been hollowed out. It no longer functions as a signaling device or a place for price discovery. It has become a utility, like the water or power company, existing solely to fund the state at a price the state can afford. Under fiscal dominance, the very nature of inflation changes. It stops being a bug and starts being a feature, tool for financial repression. By keeping interest rates lower than the rate of inflation, the state slowly erodes the real value of its debt. It is a hidden tax on every saver and every holder of the currency. The government isn't trying to pay back the debt with tax revenue. It is trying to inflate the debt away until the numbers are manageable again. In this environment, the central bank's primary mission shifts from price stability to fiscal solvency. They aren't protecting your purchasing power. They are protecting the Treasury's balance sheet. This is why every recent stress event, from the collapse of regional banks to the near failure of the UK pension system, triggers the same response: emergency facilities, liquidity injections, and balance sheet expansion. The names change, but the goal is the same. The market is allowed to fluctuate, but it is not allowed to break the system. What we are witnessing isn't price discovery, it is boundary testing. Investors push yields higher until something cracks, and then policy responds. The resulting price isn't a reflection of collective belief about the future. It's a reflection of how much stress the pipes can take before the Fed turns on the hose. For the realist, the core risk isn't a technical default. It is regime change. There may come a moment where defending the currency becomes more important than financing the deficit. Until that moment arrives, you are operating inside a managed pool. The water level is set by the entity holding the hose, not by the weather overhead. Once you understand this mechanical reality, the daily noise fades away. The interventions that seem unexpected to the public look inevitable in hindsight. If you ignore this structure, the things everyone insists are impossible will always arrive as a shock. The takeaway isn't that a collapse is imminent or that the math will fail tomorrow. It's that the game has already changed. We have moved from a world of market signals to a world of political mandates. You don't have to like the mechanics, and you don't have to agree with the policy, but you do have to acknowledge that the old rules no longer apply. In an environment where the price of money is a survival choice made by the government, the greatest risk isn't volatility. It's the belief that we're ever going back to a free market.